The first thing to recognize is that every business will transition from current ownership one way or another. Either there'll be new equity coming in, company can be sold, but ultimately every owner of every business and every entrepreneur will pass away, or God forbid, will become disabled, and there'll be a transitioning event. So I think periodically, you don't dwell on it, but periodically you should consider, what are your objectives? When that event occurs, do you want management to run the business? Are you more concerned about the people? Are you more concerned about getting the best price? Are you more concerned about the reputation? Do you have charitable objectives? And then try to operate the business not on a day-to-day basis, but on a long-term aspirational basis to accomplish your objectives.
This is the Entrepreneurs United podcast with your hosts, John St. Pierre and Rich Hoffman.
Hey entrepreneurs, have you ever thought that one day you're going to sell your company? Hopefully we all are, because the one customer that we should be thinking about during this whole journey is the customer that's going to buy our company someday. And today we have Steve Cohen. He's a partner at Devine, Millimet. He's also the co-chair of the M&A team that focuses really on the transitioning as owners transition their business and exit out of their company. So Steve, first off, thanks for joining us here today.
My pleasure. Welcome to be here.
Absolutely. So I got to hit you right off the bat with this one question. What is the biggest mistake that entrepreneurs make when they start thinking about someday I'm going to sell this business and they start preparing for that? What's the one biggest mistake? If you had to characterize, there's just a one thing. What is it?
The one biggest mistake I think that clients make is not to position the company for an acquisition. They generally grow the companies based upon their own objectives, and they don't think about what the buyer is looking for, not just in terms of growth or management, but they don't think about the risks when the buyer looks at a company to acquire. They try to identify opportunities, but also risks. And there are a lot of different ways to position a company. Hopefully it's before you go out to market, before you have a letter of intent. And this can be done 5 years, 10 years before a sale, or it could be done 2 months before a sale. But you don't wait until you received a letter of intent and say, okay, let's position my company.
Yeah. And Steve, on that note, in the book that I wrote, The $100 Million Journey, the seventh principle that I have, there's 7 of them, but in the 7th one, it's, as an owner, how do you move yourself from the CEO of the business, the operating person that's in the business, to the chairperson of the business? Because ultimately, if you don't position yourself properly, you are the product somebody might be buying, or they're buying themselves your job, basically. How much do you talk to entrepreneurs about operationally moving themselves out, building their management team within? So when somebody comes to buy the company, they're legitimately buying the management team, the company, the products and services, and not necessarily the owner.
A good entrepreneur realizes that they don't have all the answers, and they put together not only an internal team of managers to deal with situations such as when the owner sells or transitions his or her company, but part of the process is to understand what are the key drivers for continuity. One approach would be, as a company grows, an entrepreneurial company grows, they rely upon the internal management, but sometimes they should consider giving up a little control and perhaps putting together a group of outside non-employee managers. That could be a board of directors, if it's a corporation, or a board of managers, if it's a limited liability company, for example. Some entrepreneurs don't want to give up control. So another approach is to set up a board of advisors, which is a group of key people that can be advisors, but who have no vote, no say. They just give their advice. I think even before you bring in outside people, you should consider, what are you trying to achieve? Where are you trying to get into? Where are your weaknesses? Is it quality control? Is it expanding your sales? Is it territorial, to go outside of North America, how to break into Europe or the Asian market? So figure out what your needs are, and then figure out whether to consider setting up a board of advisors. And there are groups that can help you select advisors with expertise in everything from
Yeah.
engineering to physics to sales to marketing to quality control to various aspects of to legal, financial, marketing. So that's a good approach to consider expanding outside of the current employee management team.
Yeah. In full disclosure to you, Rich, and the audience, I've worked with Steve on a couple of opportunities. One of them when we were looking to sell our business, and this conversation Steve's bringing me back to you were on our board of advisors as we were going through that process, and one of the things that I really feel passionately about today is that entrepreneurs should build a board of advisors. Absolutely. Even if you're not looking to sell your company next week, you need good corporate counsel. You need good CPA. You need a good wealth advisor. You need a good insurance broker. You need a good potential M&A, futuristically looking at the business and preparing it for sale. And you absolutely need to build that board of advisors. So I absolutely connect with that. But the one piece, Steve, that's kind of resonating with me, and I feel like you and I need to get on another call in the next week or two, is in the last opportunity that we had when we were selling our business, we contacted you when we were basically in the middle of the process and starting to get term sheets. And we're like, hey, Steve, help us. You're an attorney. Now start helping us look at these term sheets. At the end of looking at all these term sheets, you were one of the people on the side of going, John, don't sell your business. Don't sell your business. Now's not the right time. And you convinced us not to sell the business against potentially, you could have made some fees and done the whole work, but you said, John, this is not the right time to sell your business. And you were aligned with our other advisors because our business was not ready to sell. We came to you too late in the process. So you mentioned earlier that maybe entrepreneurs should consider coming to somebody like yourself earlier. When should they come to an M&A counsel like yourself and go, hey, in the future, X date, I'm looking to sell my business. Help me today. And how would you help them?
I guess the first thing to recognize is that every business will transition from current ownership one way or another. Either there'll be new equity coming in, company can be sold, but ultimately every owner of every business and every entrepreneur will pass away, or God forbid, will become disabled, and there'll be a transitioning event. I think periodically, you don't dwell on it, but periodically you should consider, what are your objectives? When that event occurs, do you want management to run the business? Are you more concerned about the people? Are you more concerned about getting the best price? Are you more concerned about the reputation? Do you have charitable objectives? And then try to operate the business not on a day-to-day basis, but on a long-term aspirational basis to accomplish your objectives. If the objective is to maximize revenue, then there's a lot of positioning that should be done, or at least considered to be done. And some of it is self-explanatory. As an example, you're using QuickBooks and you don't have audited or reviewed financial statements, and you're thinking of selling within a few years. A buyer likes to see at least 2 to 3 years, the longer the better. You don't have to get audited, but you should consider upgrading to have an outside accountant at least issue reviewed financials. So there are a lot of things you can do in each area of the business. That's just one example of positioning to increase value and to try to accordion the process so that a buyer doesn't have to come in effect, audit the business that they're looking to acquire.
Okay. So is there a checklist or an outline? Because you've mentioned a lot of things, right? You need a position for sale. You need to evaluate the opportunities and the risks. You need a board of advisors. You need to have reviewed, audited financials. You need to have a really good carryover management team. There's certain things. Is there a checklist for this or an outline that entrepreneurs should be following?
They could read your book, first of all. The second thing they could do is they could sit down with someone who specializes in positioning companies. Generally, those are lawyers or business brokers or investment bankers on larger transactions. Off the top of our head, we could sit down and find out if you're adequately positioned. Some are pretty self-explanatory, like looking at your corporate records, making sure that your corporate record's up to date. Some of it is risk mitigation. After you sell your business, you don't want to be hounded with decisions that you made in good faith, but maybe they were bonehead decisions with 2020 hindsight. Most entrepreneurs make a lot of great decisions and they make a lot of bonehead decisions. But my mentors once told me, if you fall flat on your face, at least you're falling forward instead of backwards. which is a good thing. It can be a learning experience. In each of the areas, risk mitigation, make sure that the lawyers have the documents, your corporate records set up so that you have officer and director indemnification agreements so no one can second guess decisions that you made before the company is sold. And that's boring stuff. It's looking at bylaws and putting in place officer and director indemnification agreements. And someone might say, why do I even need that? I own the company. I'm indemnifying the company. But you're really protecting yourself because at some point the company will be owned by someone unrelated to you. That's who you want to protect yourself from ultimately.
When we work with entrepreneurs during a growth phase of their business, we often look at income, equity, and quality of life as potential objectives in how they build their business. You're talking about the objectives in when you sell it. And the first two you said, one was people and one was price. What are some other examples of the common objectives that an entrepreneur should consider as options when they consider objectives, not in a growth phase, but in a selling phase?
You always want someone that will treat your employees well. There are some types of transitions where you're not selling to either a strategic buyer or a private equity based backed company. As an example, what is referred to as an ESOP, an employee stock ownership plan. In short, and to simplify it, basically a business owner, entrepreneur creates a Frankenstein, and that Frankenstein is called an ESOP, employee stock ownership plan. And then that plan borrows money from a bank. And then that plan, which is a tax exempt profit sharing plan, it purchases the company from the entrepreneur. And what happens is there's a lot of tax reasons why that makes sense for the entrepreneur to defer or avoid taxes on the sale. But that would be a vehicle that you would consider if you had a strong feeling that you wanted your employees to own the company going forward. You didn't want a big private equity backed firm to do it. And it deals with philosophical thought process as to who you want being the next owner of your business. Some people do not want their management team owning the business. They want someone else. Some people feel very strongly, and that's why ESOPs are a good alternative to at least kick the tires on if you have a strong management team and a strong desire that your employees should ultimately own the company.
So I heard two things there, and it was both around people. One is looking at the ownership interest. If you want employees to continue to have some ownership stake in it, that may drive an objective in selling. Another one is the treatment of people. You had brought up price as another option. Are there other kind of big categories? You've got people, price. What are the other big categories that someone may select as an objective?
One of the objectives may be growth, and I can give you an example.
Growth after selling? That's a priority of theirs?
Growth before selling in order to affect price,
Got it.
in order to benefit the management team. As an example, I've had two situations which I found fascinating with which outside investors, investment bankers brought to the attention of our clients, which quite frankly, I didn't think made sense, but it was a learning experience for me. One was a company that sold T-shirts. It had several hundred employees, sold T-shirts. They had customer concentration issues, the way a lot of companies do, and they were getting beat up on their margins by their largest customer. So they hired a consulting firm, a marketing consulting firm that specializes, fairly large company, fairly expensive over a 6-week period. And they came back and the consultants made a recommendation that they should fire their biggest client. And I thought my clients were going to fire me because they paid a lot of money for these fancy consultants to advise them to fire their biggest client because they were getting beat up on the margins. And they said, but there's something coming down the line. And we think that if you spend a little money and you build up some warehouses and you can deliver your product faster, we think there's a better market with better margins. And it's called Amazon Prime, and it's going to be a big thing in the future. And I had never heard of Amazon Prime. I've heard of it. I had heard of Amazon back then. So my clients jumped into the deep end of the pool. They relied upon the big marketing company. They fired their largest client. They sold 2 years after that
Wow.
for a multiple of what the company was worth before.
Wow.
So sometimes bringing in the right consultants. Also had that with plastics manufacturing client that did fabrication, and they did aircraft and they did automobile and a few other areas, but they weren't certified to do medical. And another consulting group came in and said, if you borrow this much money, you could get into medical. And now they do inserts for hips and knees and everything else that's being replaced in the human body. So sometimes it takes a consultant, sometimes it takes a board of advisors, sometimes it just takes a suggestion from someone to say, what about this?
Yeah.
What about that? Doing something a little different.
Yeah. Steve, I got a question on the ESOP that I'm curious about. And I think a lot of entrepreneurs don't quite understand the ESOP. And I'm going to put my hand up and say, I've been told on multiple occasions, hey, you should consider an ESOP. And I'm like, okay, great. And let me tell you where I get roadblocks. I think a lot of entrepreneurs get roadblocked here. The idea of selling our business to our management team that we've built and we've fostered and we've grown is an incredible objective in my mind. I think it's a fantastic way to exit. And then you go to the blocking and tackling. Okay, how does this work? And if I understand correctly, let's say you sell a piece of your business to the management team, and I'm just going to pull a number out. Let's say you sell it to them for $2 million, right? That obviously has to be assessed, right? It has to be valued. There's people on both sides that value that number. But then if I understand correctly, a bank finances it so that the company now has a $2 million note on its balance sheet that it has to pay back to the bank who paid the owners. Is that the correct structure of how that works?
The structure is, if we're selling your company, John, what you would do is your company would set up an ERISA plan, a
Okay.
tax exempt plan, a 401k or a profit sharing plan. It's called an ESOP. A team of advisors value the company. You have an independent valuation done. You have a feasibility study done. And then you take it to a bank. The bank will lend $2 million to the ESOP. The ESOP will take the money and buy the stock that you own. So the ESOP becomes the owner.
Okay.
The ESOP participants are the employees of your company. On the day of closing, the ESOP is worth zero because they bought $2 million of your stock and they owe $2 million.
Okay.
The company takes its earnings and it pays back the loan through the ESOP because all the earnings go to the ESOP because the ESOP owns the company. So it's circular. The
Okay.
advantage is that ultimately the employees will always control the company, but they will have an ownership interest in the company. You will have been bought out, and there are some tax advantages, not to get into the weeds, but there's a section of the Internal Revenue Code, section 1042, that says if you sell the stock of a C corporation to an ESOP and you reinvest the proceeds in qualified US based companies and some sorts of structured notes, you never have to pay the income taxes on your gain. You don't pay capital gains tax. So if you had a company worth $50 million and you sell it, capital gains would be 20% at the federal level. And depending upon what state, you'd have a state tax, you'd have a $10 million tax. If instead you sold your company to an ESOP, if you're an S Corp, you just convert the company to a C Corp before the sale. As long as you reinvest that $50 million proceeds into qualified replacement U.S. companies, not British Petroleum or Imperial Chemical, a U.S.-based publicly traded company, you don't have to pay any income taxes. You've saved yourself $10 million. And as you get older in life and something called death occurs, you get a stepped up basis in the value of that U.S. replacement stock, and you end up having sold your company and paid zero federal income taxes. That's the magic. The other magic of an ESOP is that it is a tax exempt organization. So when that loan is paid back to the bank, the company doesn't pay taxes because you set it up as a pass-through entity and all the earnings are received by a tax exempt ESOP. So you don't pay taxes. You have a lot more money for employees. You have a lot more money to do future acquisitions through the ESOP. This isn't a discussion of ESOPs, except it's an important tool. It's a possibility for some people that feel strongly about them.
Okay. So I just have one small question we can get off ESOPs, but what if I'm not selling 100%? What if I'm selling 25% of my company for $2 million? How does that then work?
You have to sell at least 30%. There are some restrictions in order to get 1042 rollover treatment. But a lot of exits are based upon selling 49% or 51% and keeping stock outside of the ESOP and continuing to own some of the company. And there are pros and cons of that, like everything else in life. But a good ESOP advisor can walk through that process. It's probably a 2-hour discussion, a lot longer than this pod to address, but it's an important tool that Congress passed to encourage employee ownership back in 1974.
Yeah, I love the concept of it. I just never can get around that idea. But Rich, I love the idea of you build something with your entrepreneurs and then you basically put it on a position where they can continue on the legacy of what you've built.
Absolutely. And I'm curious as to the trend that you've seen, Steve, over the last, say, 10, 15 years recently in that type of movement. And what do you expect to see in the future?
It's very large. In the 90s, people didn't know what ESOPs are. There's a National ESOP Association. They have a conference in Las Vegas, a national conference every November. They have a technical conference in Washington, D.C. in May. There are regional ESOP chapters throughout the United States. We happen to be in New Hampshire. There's a Northeast New England chapter. And if people want to learn more about that, they should reach out to their local chapter and attend some of the meetings. It's very inexpensive, and you can learn more about employee ownership. But we're a relatively small law firm. We have about 60 lawyers, and we set up about 8 to 10 ESOPs each year, some years more, some years less. But it's a very strong tool in the M&A arsenal.
That's great. And you'd said with 60 lawyers, you set up, I think, 6 to 10 a year, you said. So that is a product that your team of lawyers works on with an entrepreneur. What are some other products, if you will, that you work with entrepreneurs on that would be on the same level as an ESOP, just a different angle?
Great question. Most of it deals with positioning for the ultimate transition. Some years, we generally do about 8 to 12 a year. Some years we'll do 15 or more. We have a group that's dedicated that has a national ESOP practice from Little New Hampshire. But some of the other positioning items deal with trying to figure out what the buyer is going to be looking for, not financially, but in terms of growth opportunities. One thing that I look to is what are the risks in expanding and going into growth opportunities? When a company looks to buy another company and they're doing diligence, they'll generally do something called a quality of earnings review. That's hiring an independent group, generally accounting firms, but there are a lot of independent groups, and they look at the entire cash flow, the revenue side, the expense side, the tax side. It's generally a good idea if you're contemplating going to market within the next year or two to consider having a sell side quality of earnings review done. They're not inexpensive. They cost tens of thousands of dollars, but they identify issues that a buyer is going to identify when they do a quality of earnings. Reports referred to as a financial colonoscopy. They're not fun to go through because they look at your revenue recognition, the accounting principles that you're applying in your financial statements. They look at your expenses, what you're flowing through the company. And as a result of that, there are generally adjustments made. You don't want a buyer making those adjustments because it's going to adversely affect pricing, term, sizes of escrows, how long your representations are going to last. You want to discover those early. So, one of the big things, Rich, is to consider having a quality of earnings or what's called a quality of earnings light performed before you go to market. Does that answer your question?
Yeah, that's helpful. And you'd said it may expose issues the buyers would have financially. What are the typical types of issues? Or if you were to make a recommendation to entrepreneurs and say, hey, let me save you tens of thousands of dollars on 60% of these quality of earning reviews, here's something that shows up. So you may want to look there now without even having done that. What are one or two of those places?
Sure. One big area is what are called SALT taxes, SALT, state and local taxation. And there are two types of SALT taxes. Most businesses, if they're incorporated in a state, don't stop at the state line. They do multi state business. Sometimes it's in many states, sometimes it's an occasional state. What a lot of entrepreneurs don't realize and what they don't want to spend their accountants to follow is if they're doing a little work in 2 states or 5 states or 20 states, and it doesn't make sense to register the company and to file a state income tax return. There was a famous U.S. Supreme Court decision called the Wayfair decision about 5 years ago. And not to get wonky on this, but if a company has an economic presence, which means it's providing services or products into another state, it has an obligation to file a state income tax return. Also, if it's a product that's subject to that state's sales and use tax, it may have to pay a sales and use tax return. In New Hampshire, we don't have a personal income tax. We don't have a sales and use tax. So New Hampshire businesses figure, oh, I don't have to deal with those taxes. A SALT analysis is a small part of a quality of earnings analysis. That's an area where when I'm buying a company for a client, I look at right away. And the reason is if I can find some exposure before I buy the business, I'm going to reduce the purchase price. I'm going to drag the process on. I may even ask the target company, the seller, to go through a compliance program and to open the kimono and to file all the taxes, pay the penalties, pay the interest, or sign up for state remediation programs in some of the states. So to answer your question, Rich, SALT taxes are a big issue whether you're in a state that has, if you have multi-state activity.
Yeah.
One other area is for those companies that sell products outside the United States, they don't realize that the U.S. government, through what's called a Domestic International Sales Corporation, subsidizes U.S. companies to sell products overseas by it's setting up a Domestic International Sales Corporation. They can defer the income taxes on the gross margins from overseas sales. And a lot of people are more myopic. Entrepreneurs like to expand. So if they're selling in, and it could be Canada, Mexico, doesn't have to be Europe or Asia or Australia. But that's an opportunity. It's a lost opportunity if you qualify and you're not deferring your taxes. It's a found opportunity for private equity firms who will do that. They'll acquire the company, they'll squeeze the orange, then they'll drink the orange juice. And part of that is on the expense side, and part of that is on the tax side by reducing taxes on overseas sales.
Yeah. See, one thing people may not know is you have a master's in taxation. And most entrepreneurs, when they go to sell their business, I have to believe, and you can qualify this for me or not, but if you're a small to medium sized business, so you're not a large corporation, you're a small to medium sized business, you're doing $5 million, $10 million of revenues. I'd have to guess that a large majority of those entrepreneurs call their corporate attorney and say, "Hey, I'm selling my business. Help me put the paperwork together." Is that a fair assessment that they don't actually consult with an M&A specific attorney with taxation experience? They just call their local corporate attorney?
Unfortunately, that's true. And oftentimes I'll get calls from people, either clients or people who are looking to have us guide them through the process after they've actually signed a letter of intent, which is a little ass backwards. You miss a lot of things. It's not just what is in the letter of intent, but it's specifically what is not in the letter of intent. So that's a big part of any transaction. I don't think the tax tail needs to wag the dog. If you're seriously interested in selling, you should understand a couple of basics. Sit down with your M&A lawyer, sit down with your accountant, and understand the difference between selling, having your company sell its assets versus having your company or having you sell the stock that operates the company.
Yeah.
An asset sale is taxed very differently, both at the state and the federal level, from a stock sale, or if you're an LLC, a membership interest sale. What a lot of accountants are asked to do at the beginning of the process is to prepare what's called a Monte Carlo analysis, and that is to take some estimated purchase prices, plug in the costs of the lawyers, the accountants, the investment bankers, which are all deductible and offsets, and then to look at an asset sale versus a stock sale. And this Monte Carlo process tells you how much the owner, after taxes, after federal taxes, after state taxes, after all the professional pickpocket fees of lawyers and accountants and brokers, how much is actually going in their pocket. And you'll realize that you put more or less in your pocket depending upon the structure of the sale. So it's also important if you're selling to a private equity based company as opposed to a large strategic buyer. Private equity would love the sellers to have skin in the game. So they'll either require or they'll give you an opportunity to reinvest with the buyer. So you can share not only the upside, but also the risk of going forward. And what you don't want to do is use after tax dollars to reinvest. You want to roll over on a tax free basis. And your accountants can walk you through the different methodologies, the different structures to reinvest on a tax deferred basis.
Yeah, Steve, you went to one of the other areas I wanted to go to. If you don't consult with an M&A attorney, or you go to an M&A specific expertise counsel after you signed a letter of intent, you're missing the whole objective of this thing. And I actually tend to disagree a little bit with your statement of the tax shouldn't wag the dog, because ultimately at the end of the day, Rich, you asked a question earlier, it's price, it's people, what are the reasons you're selling? Even in an ESOP analysis, really taxation plays a big piece. If you're going to sell your business this way or that way, taxation is a really big piece. And how much you're going to have at the end of the day in your take-home analysis. I've had a lot of people, you probably had it too, where they want to sell their business and then they see the Monte Carlo analysis and they're like, wait, that's all I'm getting at the end of this thing. I got to grow this thing some more, because they don't quite do the math on the analysis. So I think taxation plays a big piece. And I have two quick questions for you to end this conversation. One is, you just talked about earnout opportunities, really, which is, I'm going to stay in with this private equity firm. I'll tell you, I personally have the mindset, I'm selling 100% or I'm getting 100% of my money. I'm not staying in because I don't trust the other side of the cliff. Not because I don't trust the company or I don't trust the progressors. I just don't have that much faith necessarily that people are going to take care of what they've promised they're going to take care of. So that's number one I was going to ask you about. And then number two is, what is your current perspective on the sunsetting of this irrevocable trust estate tax kind of situation? And how much does that play in entrepreneurs right now? If you're thinking of selling your business in the next 5-10 years, should you be looking at maybe putting some of your ownership into an irrevocable trust to pass on to future generations? What are your positions on both of those?
First of all, I think the biggest mistake people make when they consider a rollover or a reinvestment, that is owning an interest in the company that buys their company, is they don't realize that if you're rolling over a million or 5 million or 50 million of your purchase price, you're actually buying a company. You should be doing diligence on the company that you're investing in the same way they're doing diligence on you. You should review their finances. You should look at their buy-sell agreements. You're going to get a piece of paper, either a stock interest or a membership interest in an LLC. And the question is, how do you monetize that? What's it worth? And if you look at most private equity backed roll ups and rollovers, you'll see that there's a waterfall. Not surprisingly, the investment bankers get paid first. The first set of founders get paid second. And it's, you remember George Orwell and Animal Farm, all animals are created equal, but some are more equal than others. There are some owners that are more equal than others based upon looking at the waterfall of distributions when one of those rollover companies sells. So I think that's one of the biggest mistakes that people make in connection with that. And what was your other question, John?
It was more of, what's your position on, should the ownership of my business be in my name or in an irrevocable trust vehicle that can be, because the estate laws are sunsetting, right? Where you can now have 13.6, I think, in tax-free to future generations. It's going to go down to 5. Is there a way to restructure your ownership into irrevocable trust?
I would, as a general rule, I would suggest having your ownership interest, whether it's a corporation or an LLC or another form, it should be owned in a revocable trust just for probate avoidance. A revocable trust, a grantor trust, that can qualify as an S corporation shareholder. I would not use an irrevocable trust unless you had some family planning opportunities or if you had some concerns with liability. An irrevocable trust is irrevocable. Most entrepreneurs are not in their 70s and 80s. They're in their teens, 20s, 30s, 40s, 50s, 60s. And an irrevocable trust can play a role for future estate taxes, but unless you have more than the current estate tax limit, which is currently, as of January, $13,610,000 per person, assuming you're a U.S. citizen. So a couple can have 26 million sheltered. I happen to think when that's sunsetted, it will largely depend upon whether there's a Republican or a Democratic administration, whether they're still speaking with each other. And I'm not taking sides, but I think it will be rolled over. And the question is, does it go back to 5 million per person or 13.6 the way it is now? My guess is they'll split the baby, as they generally do, and it'll be somewhere in between. And they'll try to come up with a new scaling system over a decade. That it'll be this amount and it'll go up a certain amount each year. But I wouldn't let estate taxes drive whether you sell your company or not. It's in the background. I don't think it's a real driver, but you should speak with a good estate planning lawyer. The differences between an irrevocable and a revocable. I'd caution you, however, if you have an S corporation and you set up an irrevocable trust, you have to make sure that it's a qualified owner of S corporation stock. You don't want to inadvertently lose your S corporation status because that's a real driver in saving taxes when you transition your company.
Got it. Steve, this was a ton of information here today. And I think if I had to boil it down to something entrepreneurs should be thinking about to close this conversation, what are you trying to achieve? I think that's something you said very early on. If you don't know what you're ultimately trying to achieve, any path will do. If you know what you're trying to achieve, there's a lot of ways to get there, and consulting with someone like yourself can really help guide them on that path. If entrepreneurs or anybody listening to this wanted to reach out to get a consultation from you on where they're at, first off, do you provide consultations to entrepreneurs to get to know them, see where they're at before engaging with you? And if so, how do they reach out to you?
Sure. We love speaking with people. We have a team of people that I lead. There are 16 of us here who buy and sell businesses as a trade and who set up ESOPs. Just contact us anytime. We do not charge for initial consultations. And I went to law school because I didn't make it as a physicist where I went to college. And then when I didn't make it as a physicist, I transferred into the business school at the University of Pennsylvania, the Wharton School. I thought I wanted to be an accountant. I graduated. I became a CPA with a now defunct firm, Arthur Andersen. I couldn't stand accounting. I was convinced that it would ultimately, they were just developing computers back then, and I didn't want to be ticking and tying forever. So I decided to go to law school. Suggest to every entrepreneur out there, figure out what it is you really want to do. Follow your passion. Even if you think it doesn't make sense, follow your passion, and it will ring true when it's time to get out.
Love it. Thanks for your time today, Steve. That was awesome.
Thank you.
Stay tuned as John and Rich unpack today's conversation.
Rich, what are you trying to achieve? It should be at the forefront of every entrepreneur when you're starting your business, when you're in the middle of your business, as you head towards the end of your business. And I've made this mistake before. Okay, let's sell the business. Then you go and get the quality of earnings. You start going to market. You start getting some offers. You're like, wait a minute, let me talk to my CPA. Then you start looking at the taxes. You're like, oh man, this is not going to be as much as I think it's going to be. Then you start seeing the legal documents and the language. You're like, well, wait a minute, what do you mean I don't control this or I don't know that? And you end up in this tailspin of going, oh, you know what? I'm going to retract. I'm not selling my company. And you go all the way back to square one. And now with all that in front of me in terms of learnings, if I go to sell a company today, it's with advanced preparation, right? How are we optimizing the potential price of this? So how are we making sure we have the good customer base? How do we make sure our team is optimized? Our gross margins are optimized? How do we make sure all these different things are ready to maximize the price? Number one. Number two, am I consulting with my tax CPA accountant and looking at all the different ways we should be looking at preparing the business for exit? Am I consulting with my legal counsel, make sure all our I's are dotted, T's are crossed? Am I getting a quality of earnings before going to market? Am I consulting with something, Steve, before that time happens? So when we go to market, our package is tight, it's clean, and we know exactly what to expect. And guess what? That will command the best price in the market as well.
And him as a guest really exposed the exit strategy part of things. The majority of our guests, we're talking about startup or we're talking about growth. And we hear very often on the startup side, the need to be really clear on what's the problem you're trying to solve for the marketplace. And how are you going to do that in a differentiated way? As I said on this podcast, in the growth phase, often we're talking about either protecting income, equity, or quality of life. And he's one of the few guests that we've had where we're really exclusively talking about the exit side and looking at what is your objective on exit. And many people would often think it's maximize money, of course. But with the relationship that's built with the management team and the people, often it's a little bit more complex than just maximize money at the sacrifice of people. It's, I want to protect people too. And how do I go about doing that? And got a lot of information on how he would recommend using an ESOP to do that. And it was interesting, the progression he used, where he said, I want to have growth for the purpose of increasing price. And then I want to have an ESOP because the purpose of increasing the price is so my management team and I can benefit from the increase of the price. So it was interesting reasoning for the growth outside of just make more money.
Yeah. If we talk about team for a second, 'cause I know it's something that we spend a lot of time on in terms of building a team for growth and building a team that can run your business and a whole bunch of things about leadership and development of your team. One of the things we don't talk a lot about here, but it plays into this factor, is when you give people raises and you give people promotions and they grow within your organization, you have to be really careful that you have the right people on the right spot of the bus, generating the right return for the company for what they're getting paid. Because guess what? If you don't optimize your team in the right spots for their benefit and the company's benefit, the first thing that happens when somebody comes to buy your business is they're going to wax those people. They're overpaid. They're not in the right buckets. They're not generating the right return. And so you as an owner, the saying, no good deed goes unpunished. Yeah. The amount of times I've potentially overpaid somebody, but then had to terminate them, put them in the wrong position, and then had to replace them. It's your responsibility as an owner. And I think we shy away from that. If we're talking about preparing your business for a transition, preparing it for an exit, you should always be optimizing your organization. And don't try and be like Mr. Nice Guy. Be the Mr. Fair Guy. Set people up for success. If you set people up for success, they will earn the right amount of money. They will be in the right roles in your organization. And if somebody comes to buy your business, they're going to continue to work with those people to continue to grow and develop your company. And way too many times, if I'm buying a company, Rich, the first thing I'm looking at is, yeah, I don't know why we have 3 people putting in this light bulb. We don't need 3 people. I'm going to get rid of 2 of them. And where the owner could have done that themselves to maximize the price and optimize their business, the person buying the business is the one who comes in and does that stuff. So it's really important for entrepreneurs as you're growing your company to make sure you're setting it up for success, not only for yourself, but for the next person who's going to come buy your business. And don't leave too much fluff in the middle, because the next person coming to buy your business is going to get rid of the fluff.
Given you and I were raised in business in the same place, I believe I know what you mean when you say, don't be the Mr. Nice Guy, be the Mr. Fair Guy. But I think on average in the marketplace, if you were to ask an entrepreneur, are you being fair in how you're going about things? There also runs a risk of somebody saying, of course I'm being fair. I'm taking the majority of the benefit. I'm the entrepreneur. I'm the one that had all the risk. That's not what you mean when you're saying being fair. So I know this isn't a podcast of you, but I'm curious, when you say that, I went, oh yeah, that makes sense. And I thought, I wonder if that makes sense for everybody. What's the litmus test on being fair in the way that you're talking about it?
Yeah, let me just give an example. And this was eye-opening for me. I had an employee, a fairly high-performing employee, but needed more, right? They could have done more. And they came to me for a pretty significant raise. This is what they wanted to get paid. And I remember going to my mentor at the time and going, hey, how would you handle this? Like, they're getting paid X. They now want X times 2, let's call it. They want a lot of money. I'm thinking about doing it because I think they'll work into the role. And the response I got from my mentor was, John, I don't think that's fair to them. And I'm like, what do you mean that's not fair to them? I was like, if you put them in that position where they're getting paid that much money, it's not going to work. And they're ultimately going to turn into a disaster. They're going to leave the company. They're going to have to go work somewhere else. And then I don't think they're going to be able to get a job for that amount of money. They're going to create their lifestyle for that amount of money. They're going to buy a car or a house. And then they're not going to be able to find another job for that particular type of money. And they're going to be screwed. And it's all going to be your fault because you gave them that big of a raise. I'm like, whoa.
Wow.
I never thought about it. I thought I was doing them a service. I thought I was going to person up and they're going to do really well for me. Guess what? We didn't give them X plus times 2. We gave them X times maybe 1.5 or 1.25. So I didn't go quite where they wanted, but I gave them, and the same thing happened. So as an entrepreneur, sometimes you feel guilty. You want to pay your people more money. They're coming to you every year for their annual raise. But then if you put them in a position where ultimately they're making too much money for the role that they're performing, either it's not going to work with you or it's not going to work with the next person who comes into your role. And that person's going to be the one that's going to pay the piper for you thinking you're doing the good thing and the right thing. So you got to be really careful and really have an eye towards take yourself out of the situation. Take your emotions, your relationship, take it out of the situation. Evaluate it. If somebody was going to come buy your business, would they pay that person that amount of money or not? And if not, that's a dangerous move for you to put that employee in that role, in that position.
Yeah, because they adapt their lifestyle to it. And you may be the only company that would ever pay them that amount of money.
Yeah, or the only person.
Yeah. One of the things I got out of this was this quality of earnings review.
Yeah.
It would be obvious that if you were a buyer, obvious if you knew about that it existed, but it would be obvious as a buyer, you want to do a quality of earnings review on the business that you're looking at buying. It's not so obvious to say, I'm not looking at selling anytime soon, but someday I'm going to have to sell. And somebody's going to do a quality of earnings review.
Yep.
I think I should pay for that now on my own company so I can make some changes before my buyer runs one of these on my company. I think that's very foresight heavy and advanced thinking that's worth considering for people.
Yeah, so I share my experience with that too, Rich. You wouldn't necessarily do a quality of earnings years in advance of selling your business necessarily. It is a painful, as you talked about, a financial colonoscopy. But I think there are profitability and financial experts, whether it be your CPA, fractional firms that can come in and help you optimize your numbers and optimize your books and make sure your margins are right and make sure your financials are tight. That's one thing. But before you go to sell your company, so before you go put an ad out there, you want to sell this business, the benefit of doing your own quality of earnings report is you'll catch anything that the buyer ultimately will catch when they're doing their due diligence. And then you know how to address it even. For example, if I told you, let's say I'm selling my house, and in the ad for selling my house, I'm like, yeah, but the windows need to be replaced, but here's the price, right? You then know, as you're coming to walk through my house, yeah, they said the windows need replaced, it's right here in the ad. So we know we're buying the house without the windows being replaced. But if I didn't have that in the ad, and you come visit my house and you're like, they want this much money for their house, we got to replace the windows. So let's deduct $50,000 from that, right? You start doing that math, and that's what the buyer will do. Is if they come evaluate your business and they're doing their own quality of earnings, they start seeing all of your new windows need replaced and all these different things that are, the junk in your business, they're going to come back and reduce the price on you and in the negotiation process. So one of the benefit of a quality of earnings is you see your own trash, but you don't know how to handle it. And you can you articulate that to the customer buying your business. Hey, here's how we're handling this situation. Yeah, you'll see this when you look at our numbers. Here's how you handle it. And you're handling the objections before they come up. And now you're not in that position, the backside of it, paying the piper.